So I talked in class on Monday night, briefly, I guess, about how to evaluate evidence. And the key thing is that it's really irresponsible to talk about evidence without talking about the assertions. So the reason why I kind of push the assertions down your throat before introducing you to an informed discussion of evidence is we really can't discuss if a piece of evidence is any good unless we know what assertion it is that we're testing for. So if we're testing for existence, then seeing something physically with our own eyes is awesome. If we're testing something for ownership, seeing it isn't that good because I see all kinds of things. You guys are sitting in chairs in my class. They exist, but they ain't yours. You don't have a receipt for them. And so seeing and touching and feeling is great for existence. It can help you with valuation because if what you're looking at looks pretty good, then there's probably no need to do an impairment on it. But if what you're looking at looks pretty garbage, then maybe your client should be impairing its value. And so I would just argue that when it comes to ownership, you will be set up by me with questions that'll say, hey, physical examining something. How is it for ownership? And you should say it's garbage for ownership. It's great for existence. And so we've spent the last, feels like month and probably close to it, talking about how much evidence is enough. Detection risk and tolerable misstatement help us determine how much is enough. Now we need to talk about the kind of evidence that we need. For the most part, we're looking for, evidence that is reliable and relevant. Okay. That said, what about instances where detection risk is high? Well, if detection risk is high, I don't care as much. Okay. But when detection risk is low, I care very much. So you can think about it as when detection risk is high, do I need really reliable evidence? Probably not. Okay. Probably not at all. But if detection risk is low, the only way I'm going to get there, the only way I'm going to achieve low detection risk is by what we've up until tonight talked about as working hard. And what I'm going to tell you is working hard means gathering a whole lot of high quality evidence. All right. And so the way that we evaluate quality is two dimensions. All right. Reliability, meaning how much can we trust it, and relevant, meaning is it appropriate for the assertion being tested? This is incumbent on you understanding the assertions. Reliability, that's a process. It's, to be honest with you, in the real world, it's probably a lot more complicated than this, but this is Accounting 415. And so in Accounting 415, I define reliability really as the sum of two things with one extra dimension if you're talking about internal documentation. So if you're not talking about internal documentation, okay, or you're not talking about inquiry of your client, which is essentially internal documentation because both are coming directly from the client, then you only have to evaluate the reliability of evidence on two dimensions. If you fail to do this, minus 72. So I'm telling you, we're defining reliability as a function of two and only two things, unless it's internal documentation. How independent is the provider and how factual is the evidence? All right. The independence of the provider. There's no one more independent than you, the auditor. So when you yourself, with your own eyes, your own brain, your own hands, when you are the evidence provider, like you are when we physically examine equipment, it doesn't get any more independent than that. Now you start calling banks and customers, lawyers. Now you're getting less than independent. You are the most independent person on the planet. Your clients' banks, your clients' customers, your clients' lawyers, they're certainly independent, but they're not as independent as you. And that impairs the evidence they give us, that impairs their reliability. It's not good or bad. This is just fact. Okay. It's fact that the bank is not as independent as you are. All right. So evidence that you get from the bank, by definition, is going to be less reliable than evidence you get from yourself. The worst type of evidence in terms of reliability is stuff that comes from the client. All right. Internal documentation. What you're going to see, I think, on the next slide is that internal documentation is improved when your client has really good internal controls. And that should make sense. If your client has good internal controls, that means they don't make mistakes very often. So when they give you something as evidence, that means it's probably right. Okay, that's what good internal controls do. The second dimension, and this is one that accounting students have struggled with, and I honestly think it's because, and I don't mean to offend anybody, but you don't understand the English language. You don't know what the word objective means, all right? And so, and I can't explain why other than K through 12 school system. Objective means, is it fact-based, okay? If there's something that you can put in a calculator and get a right answer, there's nothing more factual than that. Seeing a piece of equipment, it's either there or it's not. Those things are fact-based. If you're dealing with anything like an opinion, well, the client thinks they can collect 90% of the receivables, or, well, it appears as if the value of this is $37 a share. Those things are not as fact-based. Those things are based on some type of analysis, some type of assumptions, all right? They're not fact-based. So we're hoping, and sometimes you just can't get it, we're hoping to find evidence that is fact-based, not grounded in assumption, not grounded in, well, maybe we think, blah, blah, blah. No, we're looking for fact-based evidence, objective. That's what objective means. But sometimes that's just not possible, okay? Valuing something that isn't traded on the open market very often, who knows what something's worth, okay? So the best evidence you can get is probably from an appraiser on what something's worth. The appraiser is going to tell you, this isn't fact, this is my best guess. That impairs the evidence's reliability. It might be the best you can do, all right? It probably is the best you can do, but it's not fact-based. That makes the evidence less reliable than something that's like a punch in the mouth, that it is fact-based. So the best type of evidence is evidence that is both relevant and reliable. And a lot of times, not sometimes, a lot of times you can't get that. Most of the time you're stuck with your client's internal documentation, things like invoices, all right? Things like receiving reports, purchase orders. They're the best you can do. They're the only evidence that exists, okay? They might be highly relevant for your assertion, but they're not reliable. Why? Because they come from the client. They can, though, be more reliable when the client has great internal controls, when you're getting originals, not something that's been run through a fax machine or a copier, all right? So the general rule for internal documentation, and some of you who have audited, like Luke, you know that a lot of audit evidence comes from the client, all right? That's the best you can do on, I would say, 80% of the time. Audit evidence comes from the client. If the client has good controls, it's definitely more reliable than if the client has garbage controls. That's the rule. So this just runs through real quick the different types of evidence. There's nothing more reliable than physical examination because you're seeing something, it's either there or it's not there. It's 100% fact-based, and you're the evidence provider. No one's more independent than you. Confirmation, like I said earlier, this is a little less reliable. Why? They're independent, but they're not you, okay? When you think about going to a bank and saying, does my client have $20,000 in it? The answer is either yes or no. When you go to a customer and say, you owe my client $20,000, the answer is either yes or no. I consider those to be pretty fact-based. But when you talk about a legal confirmation, is my client going to lose this case or not? The lawyer's going to say, I don't know, this is what I think. So you can have a type of confirmation evidence that is highly reliable in the sense that it comes from somebody who's independent, but not fact-based because it's coming from an independent provider, but by definition, it's not fact-based. Is the client going to win or lose a lawsuit? Who the hell knows? Recalculation, once again, a lot of auditing is recalculating our client's math. extremely reliable. All right. Only really relevant for one assertion, and that's accuracy. External documentation, once again, if internal documentation is the first thing that we tend to get, external documentation is the second thing, meaning evidence we gather from the internet, from someone other than the client. Okay. It tends to be, obviously, it's pretty reliable in the sense that you're getting it from someone other than the client. But whether it's fact based or not, it depends on what the evidence is. It might be if it's something like, hey, what did my client pay for this? Oh, here's an invoice. They paid $37. That's fact based. Hey, you think my client can sell this thing for $6,000? I think they got a shot. That's not fact based. Both are examples of external documentation. Okay. The provider is independent because it's someone other than the client, but fact based depends on what the evidence is supporting. Supporting a price, like $37? Sure. If it's supporting some type of valuation, like the piece of land is worth $60,000, who knows? Who knows? Right? So that would impair its reliability. Internal documentation, same thing. Obviously, it depends on their controls. Internal documentation is really the only type of evidence where internal controls matter. There's a little bit of an exception. All right. Inquiry is an exception. Internal documentation is when you get a document from your client. Internal inquiry is when you ask your client a question. I would argue that both of them are probably better if your client has good internal controls. All right. I have a fill in the blank here. Step one is you have to always ask your client questions. All right. But step two is you gather evidence to support what your client tells you. I say to a student, why weren't you in class? She says, my dad died. I go, that's sad. Can I see the death certificate? Right? I asked her why she wasn't in class. She told me, and then I followed it up with evidence. All right. Observation, that's watching the client do what they say they do. A lot of times your client's going to tell you they do things. Observing is watching them. Clearly, I mean, you're watching it with your own two eyes, but also you're there. So this might be something that only happens when you're there. That's why it's not a great piece of evidence by itself, but watching them do something and then gathering evidence to make sure they're doing it when you're not there. Oh, that's a big part of control testing and auditing. Scanning, this is kind of one of those things we joke about, but it literally means looking at, for instance, your client's general ledger and seeing if there are any journal entry patterns that look off. Okay. And it's actually something that's prescribed in our fraud testing. And we'll talk more about that at some point. But analytical procedures, which we'll talk about a lot, all right? For now, just understand it's basically smell test, number crunching, do things smell right. And once again, in and of themselves, are they enough? I would say more often than not, they're not. But are they essential in audit planning? They're required. Are they essential in at the end of an audit? They're required. And during an audit, they're actually really, 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 really helpful. So this just tells you kind of where we're going. I probably talked about this in class, but this gives you an idea of things that I have up on Blackboard in terms of fake quizzes on evaluating evidence. And it also tells you I got this really good Excel spreadsheet summary of the kind of assertions that are most important or relevant for given accounts and the evidence that helps us audit them, both balance sheet and income statement accounts. And then the next time we meet, I'll tie a bow around audit planning and we'll say goodbye to this stuff in terms of we're going to move to the next part of the audit, which is controls.